Hi, Greg Dorsey here. It's Monday, July 19th at Leeb.com, Leeb.com. Stocks managed to rally towards the end of the day despite perhaps, or simply because stocks surrendered so much ground late last week. We can't point to any real positives out there right now, and the action left a lot to be desired. There's still no volume on up days. Today, for instance, trading on the NYSE was one of the lightest of the year. Volume was 22% below its 200-day moving average and 33% below its 50-day moving average. As long as this lack of conviction persists, rallies are likely to be short-lived. The lone economic data point out today showed home builder confidence has fallen to its lowest level since April of 2009. Not surprisingly, Wall Street is tempering its view of the economy. Morgan Stanley's Stephen Roach thinks the U.S. is at the start of a protracted sluggishness. Strategist David Rosenberg is a more bearish view. He thinks the recession is virtually assured given the sharp drop in this ECRI's weekly leading index growth rate. And from where we sit, it sure looks like the Federal Reserve is going to have to initiate another round of quantitative easing to keep the economy moving in the right direction. Though it will likely require more selling in the stock market to galvanize the Fed into action. In the meantime, this week is relatively light for economic data, but we will have more out on the housing sector. Traders will also be watching the Conference Board's index of leading economic indicators out Thursday. Expectations are for a 0.3% contraction, and anything less will be used as another reason to exit positions. Earnings, of course, will also be on the menu. So far, the market hasn't been impressed with what it has seen and heard, though positive surprises have topped negative ones by a 3-to-1 margin among S&P 500 companies that have reported so far. Stocks have, on balance, sold off rather than rallied on the news. While the year-over-year comparisons are going to be good for the quarter, Wall Street continues to lower its estimates as well. In the last week alone, for instance, the consensus forecast for the S&P's overall growth has come down from around 34% to a 29% increase as of today. Last week, we had tepid reception for results from major banks and tech bellwether Intel. This afternoon, IBM disappointed on revenues, which could get stocks off on the wrong foot tomorrow morning. We'll see come 9:30. That's it for now. Stay tuned. We'll have lots more for you in the coming days.